So what are we going to cover in the next hour or so? We're going to talk about what is excess and surplus lines insurance. What is it? See if this is working. Yeah. Why does it exist? Who uses it? We'll talk about who writes it, and then we'll talk about how it's regulated, how that might vary from state to state, and what it means to regulate surplus line insurance. So let's start with what is excess and surplus line insurance. What do you think of that slide transition? That's pretty cool, isn't it? I worked pretty hard on that. Deserves at least a small round of applause. Thank you, thank you. So one thing, actually I'm going to go back before I talk about this, typical transaction. First, I'd like to take the temperature of a room before we start. Who knows the answer really well to what is excess and surplus line insurance? Who has it down? I know what it's about. I'm really familiar with it. Anybody? Nobody. Okay, good. Then my time will not be wasted here. Who feels like I know absolutely nothing about surplus line insurance? I really don't know what it is. A couple? Okay, good. Who's somewhere in the middle? Somewhere in the middle, I've heard of it, some experience. Good. All right, so before we talk about what it is exactly, and I want to make sure we all have some common definition before we move forward, so we have a basis upon which to work as we go through talking about surplus line insurance. But before we talk about what it is, let's talk a little bit about what it is not, which is a typical transaction of insurance. Typical transaction, you all know insurance is regulated on a state-by-state basis in the United States, okay? And if I have an Illinois risk and I need insurance, I'm going to go to a producer that is licensed in the state of Illinois, and that producer will procure a policy for me from an insurer that has a license from the state of Illinois. That's typical transaction of insurance. Covers the great majority of the insurance that's written, okay? Surplus lines is not this, but before we define what it is, let's cover a couple of terms. You hear these terms thrown about a little bit almost interchangeably. A licensed insurer, an admitted insurer, authorized, standard markets. You hear those bandied about and used interchangeably, even though in some state laws they might have subtle differences to what they mean. But overall, in the marketplace, you hear these used interchangeably. For the purposes of our discussion, when we're talking about an insurer that is a licensed insurer, for instance, in Illinois, they don't even say licensed insurer, they say it has a certificate of authority from the director, right? Isn't that what they say? Insurer has a certificate of authority. How many Illinois people do we have here? Just you? Two? Okay. I just want to make sure I know who you are so I don't get in trouble, because I have to work with the Illinois department. So, Illinois calls it a certificate of authority. But for the purposes of our discussion, we're just going to refer to them as licensed insurers, okay? You clear on that? On the other side, you also hear unlicensed, non-admitted, unadmitted, unauthorized, surplus lines, excess lines. You hear those used interchangeably. And for the purposes of our discussion, I'm just going to call all these surplus lines insurers, okay? Extra points to anybody who knows which states use the term excess lines for surplus line insurance. I'm looking to see if any of them are here. I don't think you're. Anybody know? New York is the big one. They say excess lines. Kansas, Virginia, and West Virginia. I think those are the four that use the term excess lines. You'll hear me just saying surplus lines. A lot of people say E&S as an abbreviation for excess and surplus lines. So some terms defined there. So if we want to define what is E&S insurance, what is surplus lines insurance? It's insurance procured pursuant to the applicable statutes from a surplus line insurer when, after diligent effort, where required, the insurance could not be procured from licensed insurers. Kind of a simple equation there, right? Insurance procured from surplus line insurers when, after diligent effort, it means I tried to get it from licensed insurers, right? I tried, I made a diligent effort, There's some exceptions to that requirement. That's why I say we're required. Insurance could not be procured from licensed insurers. Sometimes it's easier to put that in a, like, chronologically. So I'm a producer, my client needs insurance. I made a diligent effort. Probably, because sometimes I don't have to under the law. We'll talk about those exceptions later. I made a diligent effort to get the insurance from licensed insurers. I tried. I failed. But because there's laws saying that it's okay, I got the insurance from a surplus line insurer. Relatively simple. Does it make sense to everybody? Are there any questions about that? About just a basic definition? That's surplus line insurance. It's kind of the opposite of licensed insurance. But you notice that whole diligent effort thing, it's kind of important in the general difference between surplus line and licensed insurance, because there's a public policy that all states adhere to, that I want to steer as much business as possible into my licensed insurers. If I can get them to write it, I want them to write it, because they're the ones that I regulate. They're the ones where I know what their finances are, that they're financially sound. I'm looking at their books. With surplus line insurers, they're almost by definition located somewhere else. Someone else is probably regulating them, but it's not me in my state. I'm not doing it. And also with the licensed insurers, if for some reason they were to fail, if they were to go bankrupt, I have a guarantee fund that protects the policyholders. On the surplus line side, you don't have that guarantee fund protection. Okay? So that's typical surplus lines transaction. That makes sense to everybody. We have a common definition we can all work with. Nobody's unclear. Okay? Let's move forward from there then. We can check that one off and say, why is there surplus line insurance? There's that great transition again. I worked hard. So, a little hard to read, but I'm going to read these out to you so that in case you're in the back row or didn't bring your glasses. So, insurance companies started as small local businesses because they were covering small local businesses. Back in 1700s, there were very few multinational conglomerates operating. Hard to believe, I know. But often these insurance companies were nothing more than just a group of businesses in a downtown banding together for mutual fire protection. Students of insurance, why is that a problem? Why do you think that was a problem? Anybody?
Diversification.
What?
Diversification.
Yes, exactly. They got a real concentration of risk right there. One of the first registered insurance companies was 1735. I think it was called the Friendly Society in Charleston, South Carolina. It was bankrupt in 1740 when they had a big fire. It lasted 4 years. One of the ones that's first ones that was created that's still operating, I believe, is the Philadelphia Contributorship, created by Ben Franklin and others in 1752 in Philadelphia. And as late as the early 1800s, they had a rule that said we will only cover people within 10 miles of the city center. I mean, so, insurance in its infancy wasn't great all the time. They had a lot of problems. They didn't know how to do it, and they had problems. So when they did, the policyholders, the taxpayers would turn to their government and say, hey, you got to do something about this. I bought an insurance policy. This insurer is not here to take care of me. And so insurance regulation was born, but it was born locally because it was happening locally. Okay? Insurance regulation, just to be fair, wasn't very good at it either when they started. They both the insurance marketplace and insurance regulation matured over time. They got better at what they did. Okay? So it started locally. Regulation started, again, they were kind of learning as they go, but eventually they created form regulation, regulating forms. And why would they do that? Why do you need to regulate forms? What's the benefit of that? Standardization, okay. Gives people a standard product that they can rely on. They know from one maybe company to another or from one insurer to another that they're getting the product they think they are. And also making sure that they're fair, that they're understandable, that they cover the things they say they're going to cover, that we're meeting public policy. I want these policyholders to have this kind of coverage, and this one does that, so I'll approve it. Rate regulation, that's another thing they came up with. Second thing on here, hard to read. Rate regulation, why would you regulate rates? Why would you care what the insurance companies charge as regulators? Don't want them overcharging. Insufficient capital. So my first answer was always that. And that still exists to a certain extent, absolutely. Initially, rate regulation started because of that, because of capital. There were intense periods of competition. And again, I said insurance companies in their infancy, they were good at it, right? They would get into these very heated competitions and battles where they would undercut each other's prices, and then, you know, they're depleting their capital, they're failing, and that's bad. If you're a regulator, you want the insurance companies to be around to pay claims, and you want them to treat the insurers fairly. Kind of the two general things that regulation does. Almost anything as a regulator you do is going to fall into one of those two categories. Making sure that the insurers are financially sound, so they're around to pay claims, and then making sure that they're treating the customers fair. They also financial and market conduct regulation, again, for those two categories. But they wanted to get those licensed insurers, the ones where they had their fingers in their pie, they knew what the books were like, they're local. Again, this is before the internet, 1700s. I think they didn't have the internet, right? They didn't even have telephones. You know, Pony Express was how they'd get information from one place to another, right? They wanted their local insurer to cover everything because outside insurers, they didn't know who they were. They didn't have great communication with any other regulators in other states about whether this is a real, you know, company or not. They wanted everything to be done by their own people, by their own regulated entities. But licensed insurers could not respond quickly enough to market changes and emerging risks when they happen. So not only is insurance developing, not only is regulation developing, but the U.S. economy is developing too. There's all kinds of changes going on. New businesses sprouting up, business expansions, industrial revolutions, and the like. And licensed insurers were very slow to react to that because regulators were, you know, keeping their arms around them a little bit. They didn't have complete freedom to just do things at the drop of the hat. They had to make sure their capital was protected. So if they had a new risk coming out that they didn't know a lot about, they're like, no, I don't know if I'm going to cover this. I don't want to cover this. I don't know enough to know that it's not too big of a risk for me to take. So licensed insurers couldn't respond quickly enough. Unlicensed insurers, usually Lloyd's and other aliens, would respond to the needs of insurers that weren't being met by those licensed insurers. So typically Lloyd's, other aliens would come in and write policies where those licensed companies couldn't overlap. Okay. So excess and surplus lines insurance started without any real legal foundation, and regulators considered it illegal insurance in the mid to late 1800s when the NAIC was starting. They created a committee to study this illegal insurance and how can we eliminate it. And the committee came back after investigating and said, we can't eliminate it, we need it. You know, and since we need it, we should find some way to control it, regulate it to the extent we can, and make it legal. So in I think it was 1898, New York was the first to pass a law that allowed for lawful transaction of surplus lines insurance. A few states followed suit right afterwards, but it took a long while. It wasn't really until the 1950s that every state had laws saying surplus line insurance is okay. and lawful. But they had four things typically in common, these laws as they were originally written, especially the early ones. A specially licensed producer to do the transaction. Diligent effort, we talked about that. I have to try to get it from licensed insurers first. Records reported to or open to regulators, and finally, the producer would collect and pay a tax. You find those four elements in pretty much every state law that is on the books today. And that was all part of that initial New York law. So regulation, as I said, it had a stabilizing effect, especially as regulators got better and better at it, and as the insurance market is maturing. It's a real stabilizing effect on the insurance industry in general, because that was one of the main aims, right? Is keep the company alive, so it's around to pay claims for the policyholders. You know, having a company go bankrupt and claims not paid, policyholders left holding the bag, that's a bad thing. For me, that's a bad thing for the elected officials that I might have to report to. So as regulators, they got very good at doing that job. And it stabilized the licensed insurers. For instance, insurance industry survived the Great Depression relatively unscathed. Certainly compared to other industries. Insurance companies did okay through the Great Depression. And that's thanks to state regulation. But the same regulation that made the industry stable also made licensed insurers slow to react to the changing needs of insurers. Okay? If there's a new thing out there that needs to be covered, licensed insurers are like, you know, I have all these regulations about what my finances can be. I can't put this capital at risk. I don't know enough about this to do anything about it. I can't cover it. Or this seems too risky. This guy's had, 3 fires in 6 years, and it's just me stepping into a situation where I will lose money. That's putting my capital at risk. That's putting my company's financial stability at risk. They just don't want to do those kind of things. So historically, licensed insurers couldn't or wouldn't cover new types of coverage, new or unusual or unique classes of insureds, very large risks where there were capacity issues, and then insureds with challenging risk characteristics, as we like to say. Maybe just difficult, unique things about them, or maybe bad loss history, high dollar claims, high volume claims, things like that. Okay? So these are the risks that would flow into the surplus line market, which we often call the safety valve of the insurance marketplace. Okay? So licensed companies cover almost everything, but as we explained, there's situations where they can't or they won't, and for very valid reasons, and those insured still need coverage. So with some protections in the laws that are written, the producer is allowed to procure insurance for them from unlicensed companies. Unlicensed companies don't have those same, they're regulated, but they're not regulated in the same way by the insurance department. They don't, most importantly, they don't have the rate and the form regulations. They're free from rate and form regulation. So they can design and price the policy in a way that matches what the insureds need, but they can do it in a way that they feel they can do it profitably without going under. And unlicensed insurers, it's important to know too, they're not insurers that couldn't get a license, right? They're insurers that choose to operate in this way, usually keeping capital, a bunch of capital on the sidelines, waiting for opportunities like a new type of coverage that they think of, or new markets that are coming out. And they're adept at, and their expertise is developing these products, new products, finding ways to do it in a way that they can do it profitably. Okay? So, any questions about why surplus line insurance exists? Does everybody understand that it's necessary? It has to be there. Given the way that insurance is regulated in this country, it has to be there. Make sense? So we'll check that off and move on to who uses it. What kind of insureds need to avail themselves of this type of coverage? So those four things I put up earlier kind of are going to give us a roadmap of how we look for what insureds are using this type of coverage. Situations where there's new types of coverage, new or unusual or unique classes of insureds, very large risks, and then insureds with challenging risk characteristics. So let's start with new types of coverage. Every once in a while, there is a new coverage that hasn't been offered before, and someone will come up with it and decide, I'm going to sell this to the marketplace. I see a possible need here because things have been changing in the industry or the marketplace. I think they need this type of coverage. I'm going to develop it. And I'm going to expand this category a little bit and talk about new or evolving types of coverage. And one good example to start with is cyber. Okay? Because it's fairly recent enough in memory that it wasn't too long ago the first cyber policy was written. I think people generally agree it was 1997. An agent out of Atlanta got together with his underwriter buddy at AIG, and they developed the first ever cyber policy. That agent had clients who were internet-based businesses that would host content for companies. You know, and back in the earlier days of the internet, when that content was just a static website or somebody's blog about their trip to Portugal, there wasn't a lot of risk involved. You know, I have a server farm. I'm hosting all these websites and all this traffic as a company. And if something goes wrong, you know, it's down for a while, then it goes back up. Nobody's really harmed greatly. But then, throughout the 90s, you started to see commercial activity on the internet that wasn't happening before. People are starting to open stores on the internet where they're selling things on the internet. And business is getting transacted. Now, if the internet goes down, or if that company rather is breached somehow, and their ability to provide services to those customers is cut off, if they're breached, if there's an attack, if there's stealing of information, they have a real liability now to their customers, those business customers that are doing their business on the internet, because there could be real losses. You know, every moment down is moments that they can't sell, that they can't gain revenue. And so they developed this policy first to cover these types of companies. It was third-party liability covering their clients in the event that their service went down because of an attack, which was starting to happen in those days. So it was definitely a new coverage. Now, a lot of times new coverages that surplus line companies will start, they'll figure out a way. And I heard one of my board members, who's a surplus line underwriter, said, yeah, developing a new product, it would kind of look like this. We'd think of it, or someone would ask us for it. So, usually one or two people in the office would kind of hunker down and figure out a way, how are we going to cover this? You know, what would it look like? Just using what we know. You know, we're experts in the field of insurance, and we'll figure something out. And we don't really have any loss history. This is a new product, but what other things are kind of like it? And we'll look at that. We'll plug that in. But we might have to adjust it for this. And they go through and they, get creative and come up with a way, come up with a product, come up with prices, come up with coverage options and schedules and limits and things like that. Then they'll pass around the office. Everyone else will put in their 2 cents worth and try and take advantage of everybody's experience and expertise. Finally, they, are going to present it to their head of underwriting, or big boss, or whatever, and they'll go in the meeting. They'll present the whole thing to the head of underwriting. The head of underwriting will say, "Okay, double the price and let's sell it." He's like, that's kind of how it went a lot of times, because the head of underwriting, of course, a little more responsibility on their head, and they have to make sure, what about the things we don't know that we don't know? And so at least to start off with, we better have a really good price on this in case there's things we don't know that happen. So they'll develop the new product, but the typical course is that this new product, after some time, license companies are going to say, oh, this has been on the market now for 10 years. We got some history we can look at. I could probably develop an underwriting manual for this, a rate rating manual, and get mine. We can offer this, and there's just often a natural flow from surplus lines to the licensed market on new products. So with cyber, though, recently, that hasn't really been happening because it's new and it's evolving. So it's not just third-party liability anymore. The nature of the risk is changing. Hackers are getting more creative and more devious. Who hackers are is changing. Are they just criminals? Are they just some kid in the basement? Are they organized criminals in another country? Or are they state actors? And all of these changes and laws are passed about if personal information is stolen when you're hacked. You have to pay for credit monitoring for people, things like that. So now there's, and all the recovery time, if you get a ransomware attack, all the recovery costs, recovery expense, now you have first-party liability going on too, first-party coverage rather. And it's still changing all the time. We started tracking cyber in Illinois as a separate category starting late 2015. 2016 here you can see, so that's around 40 million in coverage in Illinois, and you see it just steadily growing till 2022. And this number is really only through May of 2022. We're already way ahead of last year. Cyber is just one of those things that it's interesting because it's new and it's evolving. It's a natural thing to have started in the surplus lines, but because of the changing environment, it's still in surplus lines, and that happens sometimes as well. Another interesting one, well, terrorism in general wasn't something people thought about a lot before 9/11, terrorism coverage. It was or wasn't covered, or it wasn't clear whether it was covered in a policy. And after 9/11, of course, eventually they came up with a federal law, a federal backstop law that they called TRIA. They required all insurers to offer add-on terrorism to every policy, but there was a federal backstop. There were limits in the event of a certified terrorism event. There were limits to how much the insurers would have to pay, and then the government would step in after that. But standalone terrorism is something I don't see being written much outside of the surplus line market. This is not just an add-on where you're adding another covered cause of loss to a policy, to a different type of policy. This is one where you're just crafting for probably a unique or large client, crafting a standalone terrorism product for property or for liability or for both. That's another one that it was basically newly developed after 9/11 and is still pretty much in the surplus line market. Weather, catastrophe, wildfire, things that are affected by these causes of loss are not new coverages at all, but things are changing. Licensed insurers are feeling the ground shifting literally under their feet. Earthquake joke there. Okay, a couple of laughs. But flood maps that they used to rely on, they're like, this isn't really working anymore. 100-year storms are happening every 5 years, or things are changing. The nature of the risk is evolving, and so you're seeing a lot of the risks affected by these fleeing to the surplus line market right now. Transportation network companies, other developments in the auto world, transportation network companies, when they first started, surplus lines, where is the line going to be? Where's the cutoff between when the person's personal auto liability cuts off and it becomes a commercial operation covered by a transportation network company? And now I'm not just covering the owner of the car, but I have to cover the company too. And how do you craft coverage like that? And it was developed in the surplus line market. What else is going on in autos now? Driverless cars. You know, they're not widespread, but that's really going to be a whole different animal because you're going to have to be covering who wrote the software, and who installed it, who put it all together. You could, have liability reaching to the manufacturer, to the software writer, to the person that built the sensors or installed the sensors or designed how they're all going to work together. None of this has been tested yet, really, in courts. That's another thing that keeps things in the surplus line market. They tend to transfer, new products tend to transfer over the license market after they feel also, not only is there some loss experience, but it's been fully litigated. Everything's been fully litigated, and we know where courts are going to stand on some of these issues. It's another issue. So we talked about new and evolving types of coverage. Let's talk about new and unusual and unique classes of insureds. I remember when I started in the association, rodeos. There was one company out in like Utah. That was just their big specialty. Surplus line company covered rodeos. Rodeos are no different risk than most picnics that you go to. Right? They have a little higher risk characteristics. They require probably some expertise on the part of the insurer to make sure that certain loss controls are in place, risk mitigation things are in place, and to work with the insurer to make sure that there aren't disasters that require high claims. Same with carnivals and amusement parks. These tend to be in the surplus line market. It's also probably not quite a big enough market for the licensed companies, licensed insurers, to have an appetite to get involved. Storefront churches, another interesting one. Another one of my board members said, David, I don't know how it happened. I just stumbled on it. That storefront churches have a hard time getting coverage, and I have built a pretty good agency here. Just a big part of my book is selling to storefront churches. Big denominations, through their denomination, have access to programs that their denomination negotiates on their behalf, and they're able to get all their churches covered under that. But storefront churches, where they're not necessarily associated with one of the big players, they don't have that, and they're a small market, not well understood, little unique, weird, not your typical candy store operation. So again, something specialty. Here's another one that's coming up and coming. Cannabis cultivation, cannabis dispensaries, coverages for them. Why aren't they in the licensed market? Anybody want to take a guess?
Federal regulations.
Because what? Federal regulations, exactly. Yeah, it's still a Schedule 1 narcotic, right? Federally. Now they're not focusing on it, and they're letting states be a little bit of an incubator in terms of legalizing it right now. But there's nothing on the horizon right now that's legalizing on a federal basis. But there's lots of challenges in terms of banking, in terms of insurance, because these companies are very worried that they're exposing themselves to federal criminal charges by working with these people on a state basis. Plus, the fact that, covering bars that sell alcohol, that's a unique risk. Dram shop liability and liquor liability. This is another similar area. And alcohol's been around for a long time, and still a lot of it from restaurants that are getting more than, 25 or so % of their revenue from alcohol typically are in surplus lines because of the liability. So here's another mind-altering substance that can carry some of the same risks. And how are we going to cover that? Surplus line is the one that's stepping in. So we talked about types of coverage, classes of insurers, very large risks where there are capacity issues. I just went into our database and picked out a couple examples for you. There's some big ones that you can think of, like City of Chicago airports or Commonwealth Edison or Boeing Company, where you have just millions of layers of, or millions of dollars of layers of liability and excess liability and things like that that have to be covered. But I went and found a couple of, just maybe you wouldn't think of off the top of your head. An insurer called Camping World. They have RV stores all over the country. They sell RVs and RV parts, and 180 stores across the country, $1.3 billion in an all-risk property coverage. Well, one company is not going to take that whole policy. That's too much money to cover for one company. So the logical thing to do is split it up amongst a few companies. But the U.S. market is not adept at doing that. They don't have that kind of a history where they work with other insurance companies a lot, divvying up a risk into little pieces so that they spread it out amongst a bunch of companies at that level. But the London markets do. Overseas markets do. Here's the list of insurers that signed on to that risk and what their percentages were. It's hard to see, but Lloyd's of London about 66%, and then 7 other insurers all taking less than 8% each. And that Lloyd's part, that 66%, that's really not one risk-bearing entity either, because Lloyd's, as you know, is a marketplace of syndicates. It's not really an insurer. It's a marketplace where there are many, many risk-bearing entities. Yes, sir.
So is that the direct percentage or is that the insurance percentage?
That is the direct percentage on that policy. You can see these are all, Europe, UK, France, London. That's where these things happen, and these are not licensed companies. So this is not going to go in the licensed market. Another one I saw recently, Northwestern Memorial, big hospital campus in downtown Chicago and all over Chicago. They had a standalone terrorism property, about $1 billion, one policy. And here it is again, Lloyd's taking the lead, about 33%, other companies 20% and less, spreading the risk out because one company is not going to take that whole hit or having to deal with reinsuring all that or unloading it. So very large risk with capacity issues. Insureds with challenging risk characteristics. I have to make sure I'm still on time. Ooh. California expert list is a good way to kind of see some of these because it's pretty extensive and covers things that, and it gives you a chance to explain what an export list is. So there are some states that have something called an export list. These risks, you don't have to do a diligent effort on. So I mentioned exceptions to diligent effort. This is one of them. If the state has an export list, the state usually holds regular hearings about what risks need to be on it, and producers and companies will testify and try to get things on or off the export list. And they maintain this list. It's a list of coverages we know are not available in our admitted market. So why make the surplus line producers even do a diligent effort? Not really necessary. So theirs is pretty extensive. I'm just going to point out a few of them that come to mind as we go. But kidnap and ransom. I don't know if you've ever seen one of these policies. We used to get physical policies filed with us in the Surplus Line Association. So we used to look at all these things. And the kidnap and ransom, you know it's somebody rich, but they won't put their name on the policy even. So it's just a number, and it says, name on file with underwriter. Because they don't want terrorists to know that there is this coverage for this person, because if they find out that, oh, look, there's $500 million coverage, they'll kidnap them and ask for $500 million because they know that's what the insurer will pay. We already talked about amusement parks, carnivals, sawmills, vacant buildings. Vacant buildings is another one. There's nobody in there to maintain it or protect it or make sure that if a pipe bursts that it gets fixed right away. It's a much higher risk than an occupied building. So it's automatically you can go surplus lines. General liability coverages, a lot of contractors, because of defects and problems with subcontractors and people that didn't use the right material. Employment practices liability is a big one. We got explosives, of course. You're manufacturing or storing explosives. That's going to be a pretty high risk. Oil field stuff, state of Texas, boy, a lot of their oil and gas stuff, same with California, a lot of their oil and gas stuff is in surplus lines. Product recall, tattoos and body piercing shops, see that a lot? Drones is another new one. We're seeing a lot of coverage in surplus lines. Event cancellation, those are usually crafted to the event and the risk that it might be canceled. A lot of professional liability, errors and omissions, directors and officers, that kind of stuff. So there's just a peek at theirs and who kind of gives us a window into who uses surplus line insurance. Who writes surplus line insurance? We're going to talk a little bit about the companies now. As I said, originally, back in the way back old timey times, it was Lloyd's and other aliens only. Everything based in the U.S. was a licensed company, and they were typically only writing locally, so there was no surplus lines for companies based in the U.S. Just there's always people outside the U.S. coming in, writing where the licensed companies couldn't or wouldn't write the policy. Now, in the mid-20th century, U.S. insurers began to form surplus line subsidiary insurers. Remember I said that first law passed in 1898, and not every state followed suit right away, but by the 50s, every state had a law permitting the lawful transaction of surplus line insurance. So that's when local domestic insurers started saying, maybe I can get in on this game somehow. There might be profit to be had here if we start doing what these London companies are doing. So sensing some opportunity, they started forming these companies as well. And after that, you really saw the surplus line market take off in terms of just general dollar volume. Not that they were stealing risks from the licensed company. I just think more people were getting coverage where they weren't getting coverage before. But if you take the surplus line companies and create some, I don't know, segments out of them, ways to divvy them, put them into certain buckets. AM Best had some good buckets I liked, so I'm putting these up for you. They say domestic professional companies. These are U.S. companies that write 50% or more of their premium surplus lines. Then they have domestic specialty companies. They're saying U.S.-based, but they write less than 50% in surplus lines. And then they say regulated aliens and Lloyd's. Those are the other two categories. These are companies that have to file statements or file information with the International Insurers Department at the NAIC. And then that department publishes a quarterly listing of alien insurers. These are the companies from overseas that have filed financial information with us. We've gone over it. It meets our standards, and we'll put them on the list. And that's one of the gatekeepers that a lot of states use, is that quarterly listing of alien insurers that the NAIC publishes. It's one of the gatekeepers they use to allow non-U.S. Insurers to write policies in their state. So those are kind of the four market segments that AM Best defines, and then they say, here's their share of the market. So it's kind of hard to see, but the blue here is those domestic professionals. Remember I said it used to be all Lloyd's and other aliens, but here we are from 1990 till almost today. You can see that it's dominated by U.S.-based insurers, and that means that these insurers are located in one of your states, and that means one of the state insurance departments regulates that insurer just like a licensed insurer. Because they're located there, they have a license there, they're writing surplus lines in the other 49 states. So it's getting market conduct regulation, it's getting financial regulation. And if they're writing anything on a license basis in that state, there's rate and form as applicable. So dominated by that. Second biggest player, the red one, is Lloyd's. You can see that stayed relatively steady in terms of their percentage of the market. Who's getting squeezed out is the domestic specialty, the ones that aren't, they dabble in surplus lines, but not so much. You really do have to be committed to surplus lines to make it work in the long run. They're getting squeezed out. You can see they're almost non-existent by here. And then the green is the licensed aliens, and they're receding somewhat, but it's relatively stable. So these are the companies writing surplus line insurance. I gave you a list, and this will be in your handout, of some of the top groups, but it's Lloyd's, Berkshire Hathaway, American International Group, AIG, Markel, W.R. Berkley, Nationwide, Chubb, Liberty Mutual, XL, Zurich, Star, a lot of familiar names that have surplus line pups that write surplus line business, and they're the bulk of the market, overwhelming. The percentage of domestic professional surplus line insurers with top tier rating categories of either excellent or exceptional from A- and above, the percentage of those companies in 2020, 96%. So these are financially stable, well-run insurance companies. Well-run insurance companies, I know a long time ago that was an oxymoron, but they like the regulators, insurance companies have matured. There's still some that don't do so well. Every once in a while, I know you guys know there are failures. There are company failures in the insurance company, in the insurance marketplace. That same thing for the overall property and casualty industry, number of insurers with A- or above is only 78.1%. So really, domestic professional surplus line insurers come doing better in terms of their ratings than the marketplace as a whole. And that's because, like I said, they tend to be, because of the nature, because of the high-risk nature of some of the things they cover, they have to be really disciplined. They often sit with a lot of sideline capital that's going to, so they're ready for market opportunities when they come, and that gives them a little bit of a pad that licensed insurers don't often have. Between 2004 and 2020, only one domestic professional surplus line insurer became impaired. Only one in that period, compared with 240 licensed insurers over that same time. So most of those years, there were zero impairments in the surplus line market in recent history. So that's just to give you an idea of, because so long ago, the surplus line market was always thought of as the dangerous marketplace, because it used to have a lot of bad players. There was a time when, if you were to be a bad player, do you think you would become a licensed insurer or a surplus line insurer? Of course you're going to be a surplus line insurer. When I started in 1991, there were still, Illinois Department of Insurance was still issuing cease orders for fraudulent insurers in the surplus line marketplace to the tune of 1 or 2 every month. 1 or 2 every month. And by 2000, I think there was 1 a year, and I don't think there's been one since 2001 or 2002. So the marketplace has matured, regulation has matured, all those things are communication has matured. The fact that we have the internet now, and if there's a bad player, everybody finds out about it right away. That has really helped keep the bad players out of the market. So we talked about who writes excess and surplus line. Let's talk finally about E&S regulation. And I'm a regulator. What do I do about these people? These people that aren't my licensed companies. You know, they're encroaching on my state and taking risks that I feel like my licensed companies should be able to cover. But hopefully my explanations have gotten me past that point to where you say, okay, it's a necessary marketplace. But we do have laws, and they do need to be regulated in some way. So 2 possible entities to be regulating in this arena would be the insurers or the producers. Those were pretty good animations too, weren't they? I wanted to have sound effects with that, but yeah, it would have taken too long. I could have created it. I'm a musician too. I play in a band, and an Irish band in Chicago for about 20 years. And here I am up on a tangent when I don't have a lot of time left. But let's talk about regulating surplus line insurers. Nice segue, David. Going from Irish music to regulating surplus line insurers because they go together. So since the insurer is a non-licensed entity in your state, you really have less regulatory control over the insurer. It's not as easy to do something about the insurer itself. You do have kind of a little bit of a gatekeeper, something in your law usually about what insurers can or cannot write, whether they're eligible or not eligible to write in my state. Some states even have eligibility lists. These were a lot more prevalent before 2010, because 2010, this federal NRRA thing was passed, and we'll get into that in a second. But it's something where the same way the department might maintain a list, that export list that I talked about, of here's risks that can be in the surplus line market, they'll maintain a list of companies. Here's the companies, brokers, you're allowed to use. I've looked into them, they're okay. Illinois never did that. They told me that, we don't want to be in a position saying the company is okay, because what if they go bankrupt? Would it come back to us? Would it be a political nightmare for us that we put our imprimatur on them saying they're okay and they failed because there's no guaranteed coverage protection that policyholders are told, and we look really bad. But a lot of states have them, and they function pretty well. And usually what they do is they say you have to have a certain amount of capital, certain amount of policyholder surplus. You have to have a good reputation. We want to look at what your assets are and make sure they're adequate. Some of the same things that you probably do for your licensed companies. But that federal NRRA was passed in 2010. It went into effect in July of 2011 and usurped some of your power in this area. Okay. The federal law said, it was called the Non-Admitted and Reinsurance Reform Act, NRRA, and it was the first federal law that ever dealt with surplus lines. And it said, a state may not impose eligibility requirements on non-admitted insurers domiciled in the U.S., except in conformance with two requirements that are in the NAIC's model law. Okay. And they said section 5A2, and all that says essentially is that the insurer must be authorized to write the type of insurance in their domiciliary jurisdiction. So if they're going to be writing property in Oklahoma and they're domiciled in Washington, they have to be licensed to write property in Washington in order to do surplus lines in Oklahoma. Okay. And then the other thing that the NRA says is policyholder surplus, whatever your minimum is in state law, or 15 million, whichever is greater. Okay. 15 million has been the standard in a lot of states for a long time. A couple of states have raised it to closer to 45, 50 million. Not a bad number to shoot for. If you're ever looking at your state law and it still says 15 million, don't tell my board I told you this, but you might want to up that a little bit. The industry wouldn't be happy about it because they might lose a couple of possible markets that they use, but 15 million is pretty low. The other thing that the NRRA says is number 2, they cannot prohibit a surplus line broker from placing non-admitted insurance with an insurer who's domiciled outside the United States if they're on that NAIC quarterly listing of alien insurers. So if they're filing with the IID at the NAIC and they're on that quarterly list, as a state regulator, you cannot prohibit your brokers from placing insurance with that insurer. Not a bad situation to be in because the IID does have pretty extensive plan of operation where they do review the financials of these people, of these insurers that are from overseas. So it almost takes it out of your hands. It's like you can wash your hands of those alien insurers. Despite all this, despite the state, this law saying that the state can impose criteria on U.S.-based insurers other than those two things, or non-U.S. insurers other than the quarterly listing, states still do maintain eligibility lists. and the way I've heard it phrased to me is, well, these are the ones that have proven to me that they do have that 15 million and that they sent me documentation that they're authorized in their domiciliary jurisdiction, or they've communicated to me or sent me confirmation that they're on the quarterly listing. And they'll do that list, and then they'll tell their brokers, these are the only ones you can use. So when you're dealing, if you're a state that has a list like that, for instance, you can, if you're dealing with an insurer that's not behaving like you would like them to, you could say, we could take you off the eligibility list if you're not, cooperating, if you're doing things that we feel might be hazardous to our policyholders. So you have that possible regulatory tool with those insurers. Other than that, maybe as directors are allowed to issue orders. In Illinois, I think you heard me say cease orders. They had cease orders for insurers that were bad players. And they have the authority to issue orders to their brokerage community saying, you're not allowed to procure insurance from this insurance company anymore. Threaten a company with that, they're gonna pay attention, or other orders to the company about what they should do. Again, your ability to enforce those orders under your code might be limited because it's not a licensed entity. But a reputable insurer is going to take note. They're not going to want their name bandied about, sent out to the brokerage community in orders saying they're a bad player. They don't want that. That's bad marketing. So it's certainly something you can have up your sleeve when dealing with insurers. Because really, with insurers, your powers are limited as a regulator with the surplus line insurers. But you do have those possible things to do. And again, you're lucky because the market, you're in the regulatory arena now at a time when surplus line insurance is not the Wild West anymore like it used to be, because it really used to have a lot of bad players. A lot of companies whose assets were some copper mine in Bolivia, much better now. So regulating surplus line producers. On this side, all right, this is a licensed entity for you. You license these people, so you have a great deal of regulatory control, and they have numerous responsibilities under your surplus line law that you, as a regulator, should or can certainly make sure that they're complying with. And I'm sure you already have structures in place that do that, but this is kind of a review of what they are. They vary from state to state, but there's a lot of commonality between the laws. I have gone through all 50 laws, surplus line laws in the U.S. pretty extensively as part of a committee with the American Bar Association that's putting together an annotations to surplus lines statutes book that should be out soon, I hope. But this is my second go around. This is the second edition I've been involved with. And if you've seen one state surplus line law, you've seen one state surplus line law. They are all pretty different, but the themes are the same. Some of the general concepts are the same. They word them differently. They use different terminologies, but they have a lot of similarities. Transactionally, every transaction in the surplus line market has to have a licensed producer involved. Okay? You find something going on, and the producer isn't licensed, and they have to have a surplus line license or surplus line authority under their license in order to do it. If you find someone that doesn't, that's a regulatory action on your part. That's violating your law, they're operating outside your law. There we go. It has to be an eligible risk. So if you look through your laws of your various states, you're going to find some of them that say things about surplus line insurance, when it's usually in the definition section, is insurance written on property, casualty, defines what types of insurance can be written in the surplus line market and which often can't. It might say you can't write workers' comp, except on an excess basis. You can't write primary personal auto. It might list certain coverages. A lot of times there's limits around personal lines. Or it might say you could do homeowners or auto, but only if they've also been rejected by the residual market. You know what residual markets are for homeowners or auto? You might have a FAIR plan. Have you ever heard of that? It's a plan that covers homeowners who are rejected by licensed insurers, but they get to go to this one, and this is kind of a take-all-comers, state-sponsored plan that's usually funded maybe by the licensed insurers on a joint basis or something. You can figure out some way to have this residual market that will take everybody. Same with auto. Automobile insurance plans that take usually higher risk drivers that will at least give them the minimum coverage required under the law. But some states require that you go to a residual market first before the surplus line market, things like that for personal lines. But it has to be an eligible risk. You have to make that diligent effort to get the insurance from licensed markets. Public policy, I want to steer as much of my business as possible into licensed insurers. That's where the guarantee fund protection is. That's where I am regulating the insurer extensively to where I know that my policyholders are protected and being treated fairly. I trust that it's happening in the surplus line market, but it's another regulator that's doing that for me. It's a regulator from another state or even another country. There are exceptions to that diligent effort. I talked about one of them, which was that export list we went over. But there's also that NRRA, that federal law that we saw the quote from, also had something in it called an exempt commercial purchaser exception, where a commercial purchaser that meets certain size and sophistication levels, you're allowed to deal with them without doing the diligent effort, provided you give them notice. Okay. And I won't go into the details of what those levels of size and sophistication are because they go on for pages. It's really extensive. But there's certain large, sophisticated insurers where you don't have to do it. Diligent effort. There are 4 states that have no diligent effort. They've eliminated it in their law. I think this is a dangerous practice. I mean, we have diligent effort because it enforces the public policy that insurance should first go to my licensed companies, right? They're the primary market. Surplus lines is a secondary market. And when you take that away, it's like you're putting them both on even footing and they can compete with each other. And then it kind of blurs the lines. From a regulator standpoint, I don't like it. From a market standpoint, I don't like it because if I'm an insurer, now are you going to start treating me as a regulator? Are you going to start treating me like you treat your like your licensed companies? You know, am I going to be subject to rate or form approval? That defeats the purpose. I need rate and form freedom to be a surplus line company. That's what makes me work. That's what makes the market work. So I think that's a dangerous blurring of the lines, but it's happened in 4 states. See if I can remember what the 4 states are. Wisconsin, Louisiana, Mississippi, and Virginia, I believe, right before. They have done away with it entirely. A better approach, and I don't want to brag here, but it's a law that I wrote in Illinois that has more targeted reforms. And I'll give credit where credit is due. I stole this idea from the guy that does what I do in New York. Commercial wholesale transactions. Why don't we just do away with diligent effort for those full stop? Because in a commercial wholesale surplus line transaction, the retail producer, right, that just a regular old licensed retail producer in your state, he's got a client, they need insurance, he's going to go to the markets he has. Those are licensed markets that he generally deals with. He can't get insurance from them. He's going to go to a wholesaler and say, you have access to more markets. Will you get this? Now he has to split his commission with the wholesaler. And they're not going to do that if they can get it covered by a licensed company. So it's almost like the financial incentive replaces the diligent effort as an enforcement mechanism for that public policy that, hey, things should go to the licensed insurers first. So there's a financial incentive for the retail producer
to work with these licensed markets, and they usually have access to at least 3, 5. If they're in some agent network, they might have 10 or 15 that they can get to. So if there's any way they can get it and get all their commission, they're going to do it. You know, there's no reason then to go through the unnecessary effort of having that wholesaler then also go and try some licensed markets when we know that there are already, 3 to 10 markets already turned it down. So that's not a bad reform. I'd love to see that go to other states. We also did some things about reducing the number of diligent efforts you have to do, because like if you have a master policy with a lot of insurance that you're adding on, you're going to go to your licensed markets and get declinations for everyone when you know that they're not going to take it. The licensed underwriters get mad at you after a while. Why are you sending this? I just rejected one of these yesterday. You're ruining your relationship as a broker with your licensed market because you keep sending them and making them give you a declination because you need it for your records. And same with certain program business, high volume program business. And we did reforms in Illinois where you still have to do a diligent effort, but just 1 year. Just 1 year to make sure there aren't licensed companies right in. That's a reasonable trade-off to where you're not doing a lot of unnecessary work, but you're still enforcing public policy. It has to be an eligible insurer. We already talked about kind of the gatekeeper thing and how the federal NRRA has framed that for you. But for each transaction, eligible risk, eligible insurer. There's certain notices that have to go out to the insured because, as you all learned today, there's certain protections that aren't available under surplus line policies that are available for all the policies written in the licensed market, like the guarantee fund. And the insured needs to know this is the deal with this policy. This company fails, I'm left holding the bag and not covered. That's usually part of every state's notice that they require in the surplus line policy. They're all different. We would love as an industry to get a standard 50-state notice, but we are where we are. Record keeping, if you want to enforce what's going on, if you suspect that something is a foul or a miss amongst some of your producers, they're generally required to keep records. You all have different retention times, but they're generally required to keep their records and their premium records all separate on their surplus line business, and they are usually open to your inspection whenever you want to see them. If you need to go in and do an audit on what they're doing on the surplus line basis, you should be able to figure it out. Generally, there's some reporting requirements, state to state, and you need to enforce that they're doing that. Often that data helps you regulate your license markets different. You might change what forms you're regulating if you want to steer more business away from surplus lines and into licensed market. And then taxes, just because you can. May as well. So, any other questions about regulating surplus lines, insurers, or producers?
So in Illinois, you're the term non-standard auto. Does that fall? No, it's not correct.
Right. Those are typically companies, correct me if I'm wrong, that would that tend to operate with a lower tier of insurance. They're not providing premium auto coverage. They're usually just doing the basics. And right?
Well, yes and no. So the non-standard auto industry is kind of a large industry in the United States. I'm somewhat of a subject matter expert on the topic. But what they are is, generally speaking, is their clientele generally individuals that have difficulty maintaining insurance protection over an extended period of time. In other words, they'll draw coverage for over 31 days, 31 days is a day, and then they generally get into what's considered the non-standard market. It's a misnomer. It also picks up some of the drivers that have, let's say, colorful driving records where they have a high number of NPR. But generally speaking, the non-standard market is going to be minimal policy limits, individuals that are generally just getting liability and protection.
Right.
I call them the working people that just need auto insurance. They know.
Yeah. But it's still a licensed company.
Yes, it goes through a license company, right, it's still subject to all the regulatory oversight of the departments.
So, and that's one of those things where when I was putting those terms up there, non-standard, people bandy it about as if it's interchangeable with unlicensed, but here's the situation, obviously it's not. So, yes.
You were saying there was like one surplus line provider insurer that was impaired as compared to like 200 or something.
Yeah.
Is there anything you can point to, like why that would be, or what caused that?
Why there aren't so many in the surplus line side?
Yeah.
As I said, the fact that they tend to be more disciplined, they have to be because they're dealing in riskier territories with more unknowns. So they tend to be a little more disciplined, and they tend to have higher reserves. Sideline capital that's waiting for market opportunity, and that gives them a pad. So they, even if they do make some mistakes, they have some extra reserves to fall back on. So it's usually their financial strength. That's about all the time we have, and that is the end of my presentation. So I timed it pretty well for an old guy, and I thank you for your attention.
The Institute's Griffith Foundation, the Insurance Regulator Education Foundation, and the Katy School of Insurance at Illinois State University thank David O'Kasich, CEO of Surplus Lines Association of Illinois, for sharing his expertise with us. To learn more about Griffith Foundation program offerings, please visit www.griffithfoundation.org.